In today's market is simply accessing money. And in this business, economic development business, it's either people are looking for really cheap money because they have access to money when they're large public companies, or they are looking to access to capital. And those are really the two challenges, and really they fit in those categories. Access to capital or cheap money. We have really a problem both in today's market. Our last speaker spoke about the meltdown, and it truly was a meltdown in the capital markets and availability of cash, because basically Wall Street bundled up mortgages, they bundled up credit card payments, and they would wrap them into bonds and sell them in the market and raise big, huge amounts of money. And that source of money dried up. So basically, 70% of all the money that was used to, or borrowed, was raised through Wall Street versus banks. 30% really came out of banks. And you think most of the money that people do projects with are borrowed from banks, but it really came from bundling assets, wrapping them up, and selling what's called collateralized debt obligations. They would sell them in the marketplace. That source is dried up. I think it will come back, but buyers are real hesitant to buy that kind of product simply because there was so much risk involved. Then when you were trying to get, as a buyer, holder of that asset, when you're trying to sell it, when the markets began to melt down, there's a panic sell. So the only way you could sell those products was to lower the cost. So it went from a value of $1, next day it was 90 cents. In order to sell them, you began to sell them at 70 cents, 60 cents, 50 cents on the dollar, simply to get rid of them, and that's why the market's simply plummeted. But as you can see, the challenges in today's market: limited access to credit enhancement, which I'll talk about in a bit, higher interest rates when you can borrow the money, lack of really conventional real estate lending, because so many lenders have non-performing portfolios that they don't want to keep adding to those portfolios. So you have, in order to get your money, you have higher equity contributions, which makes it harder to do a transaction. You have obviously lower loan values, and the sponsor quality is very important, meaning the borrower or the developer is now a very, very, very important aspect of borrowing. In 2007 and before, money was chasing transactions, and just about anyone could borrow money on a good idea. And today that's changed. Just a little background on the bond insurers. You can see where if you're familiar with bond insurance, usually a bond insurer insures an already investment grade credit. So if you're an A credit, you want to get bumped up to a AAA in order to save on your interest cost, you would go to an insurer. They would, for a fee, give you their rating, and you could go into the market and sell debt at a AAA versus an A, and what you paid in premium to buy the insurance was less than what you saved on your overall interest rate cost. And you can see a lot of these organizations insured these CDO models, or these CDO issues, where they bundled up mortgages and sold them. And when they began to crash and people stopped paying, the insurers had to come to the table. And you can see the FGIC, MBIA, AMBAC, they were all huge names. You could get in your deal insured by one of these guys, AAA, you went and sold it, and that was that. Today you can see they aren't even rated, or they're double C, which is super junk. And most of them are out of business. Now, Berkshire Hathaway, Warren Buffett's company, obviously saw an opportunity and said, gee, if I create a AAA insurance company, I may be able to control this market. So that's, smart business people do smart things, and that's probably a good move by him. FSA and Assured Guaranty are the only two insurance companies that are still in business. You can see banks. Banks have been hurt as well. A lot of non-performing assets, and basically what happens is their ratings drop. In order to issue a bond in the marketplace,